Let us move on to our keynote address by our chief guest, Dr. Ishrat Husain, former governor, State Bank of Pakistan. Welcome, Dr. Ishrat.
Bismillah ar-Rahman ar-Rahim. Distinguished ladies and gentlemen, it's a great pleasure for me to be here, and I want to thank the organizers of this conference for providing me this opportunity, which is very timely because we are starting a new chapter in the banking reforms. So what I want to do this morning is to place these recent developments and the future evolution of digital banking in the larger context of Digital Pakistan strategy and the financial sector reforms. This is an ongoing process. It doesn't end. While digital banking and e-commerce are ingredients of the overall digital strategy, this morning, looking at the audience, I would like to limit my remarks on the financial sector reforms and how the digital banking fits into that. We should not forget the purpose for which the SPP is promoting digital banking, and that is an effective tool for strengthening financial intermediation and financial inclusion in the country. In the pursuit of a larger, equitable, and sustainable development of Pakistan. So we should not really focus on the small piece, but contextualize this in what is the purpose of the digital banking. Banking, I would add a caveat, given the present situation, the banking sector performance cannot be isolated from the overall macroeconomic environment. When the environment is stable and the track record in management and governance is favorable, banking sector does well. Under the present fragile, fluid, and uncertain environment, it would be unfair to expect that the banks and other financial sector institutions would do well. But that is the context for the present. But we are talking about the future, and I don't think the present situation would persist. The first generation of reforms, and because there are a lot of youngsters, some of them may not have been born, or some of them were in schools, I would like to remind them as to how this financial sector reforms started, which is an ongoing process. It started in 1990s, but got an accelerated momentum in early 2000s. And what did it focus on? Liberalization of the financial system, privatization of nationalized commercial banks, autonomy and capacity building of the state bank, which is the regulator, decontrol of pricing and financial products, abolition of direct credit ceilings, and reliance on market mechanism for allocation of credit. Recovery of non-performing loans was stepped up by forming a corporate and industrial restructuring corporation, which also helped in the revival of SIC units. A code of corporate governance was enacted and enforced through a 3 or 4-tier structure. Appointments and chairmen of the COs were made on a set of predefined fit and proper criteria. So the charlatans cannot come and occupy that space. A number of banks were either asked to wind up businesses or merge, and delinquent boards were suspended or dismissed, creating a deterrent effect against malpractices. Minimum paid-up capital requirements were doubled, and capital adequacy was related to risk-weighted assets. Continuous off-site monitoring of the banks and the DFIs ensured that they operated in a safe and sound manner and complied with the parameters which are acceptable under the risk management framework. Timely and effective enforcement actions were taken against those who were found in contravention. Disclosure of financial conditions were aligned with international financial accounting standards, and external auditors were pre-qualified and divided into two categories to audit the banks according to their paid-up capital. Credit ratings by independent certified agencies were made mandatory for the banks and disclosed to the public. As a result of these first-generation reforms, the banking sector ownership structure shifted from 80% under the nationalized commercial banks or the public-owned to 80% under the private banking assets. Instead of subsidies from the exchequer, the banks have become profitable, and last year they contributed 200 billion rupees in form of corporate taxes. Customer service standards improved, quality of human resources inducted was quite high, and technology started to seep up in the operations. Financial soundness indicators surged upwards to meet the Basel Convention, and non-performing loans shrunk to single digit. Despite these achievements, ladies and gentlemen, I am not very much satisfied with the progress. And I believe that what Nadeem Hussain was telling has a lot of validity as far as the banking sector is concerned. A large number of issues and problems have surfaced since the completion of the first generation reforms, and that need to be resolved. The outreach of newly privatized banks, duly recapitalized and earning huge profits, remains limited to corporates, big name and high net worth individuals, trade financing, and fee-based activities. They did not make any efforts to extend credit to underserved sectors such as SMEs, small and medium farmers, low-cost housing, personal and consumer finance. Their network in underdeveloped areas was confined to deposit mobilization rather than lending. Prudential regulations were amended to enable the banks to lend to these sectors. To broaden the access, two new modes of banking institutions were introduced. One was those who shunned the banking due to their faith were given the opportunity to choose Islamic banking, which offered Sharia-compliant products. The other set of institutions, which Nadeem pointed out, was the microfinance banks, and we took the pride in becoming the first central bank in the world to regulate the microfinance banks against the advice of my mentor, Professor Yunus, who is a Nobel Prize winner and a Grameen Bank. He said, Ishrat, you are making a mistake. You will stifle the microfinance banks. Lo and behold, today, most of the central banks in developing countries are now regulating microfinance banks. So that was what we had done in order to cater to the people at the lower end of the spectrum who never had access to the finance. Despite this, we are sorry to say that we wanted the microfinance to serve the women entrepreneurs, but the progress has not been great, and they are still confined to the big cities and not gone into the smaller towns or the rural areas. To meet the needs of the project finance, we established these joint venture DFI companies with the assistance of the foreign partners. An upsurge in all the activities was noticed in the earlier years in broadening the access, and as was pointed out, the SME actually went up to 17% of the total private sector credit. But unfortunately, the momentum has slowed down once the government became the dominant borrower, and the results 20 years later today are really disappointing. The size of the banking system is small relative to the economy and to its peers. The advanced deposit ratios have tumbled below 50%, and most of those assets are invested in government securities. The share of SMEs in private sector, as I pointed out, has come down to 7% from 17%. Agriculture credit has remained stagnant in relation to demand. The number of accounts in the banking system are still quite low compared to our neighboring countries. In comparison to our peers, Pakistan lags behind in terms of financial market development, financial access, depth of financial institutions, credit to private sector, insurance penetration, and development of capital markets. And let me give you some numbers. Private sector credit as percentage of GDP in Pakistan is only 15%, while it is 55% in India and 39% in Bangladesh. Firms and individuals have very limited financing avenues available to cater to their savings and investment needs. Pakistan's stock market has only 250,000 retail investors compared to 12 million in Dhaka Stock Exchange and 69 million in Mumbai Stock Exchange. No doubt that the above outcomes arising from dismal performance of financial formal sector industry are to a large extent responsible for recurring macroeconomic balances, frequent balance of payment crisis, in addition to the government's role as a borrower in the banking system. But I would be remiss if I don't say that the role of the banks cannot remain unscathed. The latest data shows that only 21% of the adult population has a bank account, compared to 78% in India and 53% in Bangladesh. As a consequence of the low deposit GDP ratio, Pakistan's national saving rate has never exceeded 15%, and that we should thank our workers abroad who are remitting 5 to 6%, this year maybe 7%, of the GDP as the savings, which are now part of our national savings. Domestic savings are below 10%. And how can you have an investment of 20%, which is required for growth, if your savings rates are low? And that's why you have to resort to borrowing both from the banking sector as well as from the external borrowers. And we are up here as far as our indebtedness is concerned. So this is for you to think as to how you can mobilize the savings, which, as you all know, are intangible, illiquid assets, and they have to be liquefied and brought into the formal financial sector. Now, we have to realize that today, the external debt servicing takes away 85% of your export earnings. And this is not a sustainable situation. So we have a responsibility in the formal financial sector to mobilize savings and for the government to curtail its fiscal deficit. Unless we do that, we will be going to the IMF and to the external borrowers every now and then. Now I come back to my vision, and I'm grateful to Nadeem and Shahzad Dada for pointing out. Back in February 2001, 22 years, in my address to the Institute of Bankers, I made the following plea. I quote, "We have to consider e-banking not only as a technological issue, but also as a viable business proposition, as the number of internet users in the country is growing exponentially. The state bank and the government can act as facilitators and problem solvers, but the banks themselves will have to gear sooner than later to reap benefits for e-commerce. They have to enforce deadlines to move to this mode of transactions, which is the e-banking. Now that the licenses have been granted for digital banking, I would still reiterate the same message 22 years later. There is no reason that the existing commercial banks, and we heard the story of UBL, who are allowed under their existing license, cannot embark upon this line of business. And we have a story which is very, very illuminating. I learned a lot, Shehzad, from your interview. The journey started in early 2000s because this was a vision, but you are very good in vision in Pakistan, but execution of that vision is a problem. But we had to start the journey when the State Bank decided to mandate all the banks to join one of the either two ATM switches, which were not talking to each other. And that was one link, which played a critical role. But still, after 2 decades, the number of ATMs remains only 17,000. And only 1 million transactions are taking place every month, mainly for cash withdrawal. 96% of the withdrawals are cash from ATMs. The Electronic Transaction Ordinance was promulgated in 2000, providing legal recognition to digital signature and documentation, reducing the risks associated with the use of electronic medium of business. Commercial banks were allowed to open and operate internet merchant accounts 22 years ago. SBP acquired SWIFT connection and made it mandatory for the banks to acquire SWIFT connectivity for settlement of cross-border financial transactions. The other major initiative the SBP took was to complete the largest single project of computerization worth $30 million to fully automate the state bank operations, set up a data warehousing, and establish electronic links with the banks. At the same time, real-time gross settlement system, now called PRISM, was set up to provide a platform for wholesale transfer and settlement of funds. By 2002, almost 40% of the bank branches had been automated with phenomenal growth rate. The number of online branches jumped to 1,356 in 3 years' time, an increase of 376,000. During the last 5 years, progress in e-banking has been impressive, and I want to commend the State Bank of Pakistan and its leadership for that progress. Its share in the total value of retail payments has risen from 24 to 42%. But, as everybody pointed out, the paper-based transactions still dominate with 190 trillion rupees. This is the slice of the pie the digital banks have to nibble forcefully, not on the edges, but go into the deep dive and raise the share of e-banking to at least 80 to 90% in the next 5 years. Currency in circulation has doubled in last 10 years and is boosting informalization of the economy. The number of internet banker user is only 8 million, and that of the mobile banking is 12 million. So even we add this up, this accounts for only 20% of the unique mobile phone users. So you 5 banks have a substantial market which is 80% of the mobile phone users. And the number of the smartphones with 3G, 4G is actually rising, and broadband penetration rate is also rising very rapidly. So here is your chance. I now turn to the policies which the digital banks should pursue to advance the goal of financial inclusion. I think the granting of these 5 licenses by the State Bank is only a first step in a long journey. And I consider this as the right step in the right direction. I want to congratulate the winners, but let me also say that the hard work begins now, as the expectations from them, both by the regulator as well as the public at large, are quite high. First, they have to demonstrate that their transaction costs are lower than the existing providers. The customers enjoy much greater convenience as they save effort, time, and hassle. The fees and service charges are lower while the speed of transactions is faster. Accuracy of reporting is better, payments are secure, and cybersecurity is assured. In other words, this new breed of banks should display high level of efficiency at lower cost. Second, they have to diversify their asset base functionally, sectorally, geographically, by size and gender. Commercial banks are earning fairly reasonable margins by investing in risk-free government paper. With the IDR today is 70%, which is not what the banks should be actually doing. This is stifling private sector growth, particularly in those sectors and geographies which have the potential for absorption of credit. These are the areas where financial sector as a whole, but particularly the banks and the Islamic banks, have been unable to make forays so far. Because, very naturally, the alternatives for them are fairly attractive, and reaching out to these underserved segments is both risky as well as costly. Why? Commercial banks do not have access to a lot of relevant parameters and data to properly assess prospective borrowers. Small borrowers, particularly females, are also unable to meet the documentation and collateral requirements of the banks. The administrative cost of processing thousands of small loans impairs the profitability of these banks. By using machine learning and data capture and data analytics for discerning the patterns, the digital banks can develop credit scoring models for on-lending to the clients who do not have to go through extensive documentation or are able to offer securities, collaterals, or guarantees. The CRM platform can track customer history and provide quick feedback and online communication. I do realize that there would be upfront costs in research and development by these banks to develop these models, but let me also say these costs should be considered as investment in acquisition of customers, expansion of network, robust screening of credit risk, establishing competitive advantage, and increase in volume of business in the future. They should be considered as an investment rather than cost expenditure. This would take a few years, and you would have to be patient, as perseverance would ultimately pay off. My advice, those who are looking for instant gratification and quick returns would be disappointed, as this is a long-haul journey. Third, the digital banks have to develop a portfolio for investment, as I earlier pointed out, in sectors such as SMEs, small and medium farming, low-cost housing, but also in non-traditional economic and social activities such as human development by providing loans or qarz-e-hasna to students from poor families who are talented but do not have financial means to study. And my experience with IBA, where we had a National Talent Hunt program, really reinforces my belief that there's a lot of talent which is being neglected today because they are not given the opportunity to go for advanced studies. So please try to tap this talent of the country. Program lending and cash flow lending in SMEs and agribusiness would become easy for the DBs to handle as compared to the commercial banks. They should also provide financing for educational and health facilities and agribusinesses to private entrepreneurs in areas outside the metropolitan cities where the rising middle class has demand for quality services. China's industrial success owes a great deal to their town and village enterprises. And you would be surprised that how rapidly urbanization is taking place. I started my career as a civil servant at the age of 21. And now I go around the country and I see all those villages have now been transformed into vibrant cities. But the formal sector and the government are not paying attention in order to provide them the kind of services which they need in order to become, a viable urban center. Fourth, collaboration with fintechs should be incentivized to help the usage by coming up with APIs so that the banks can enhance business efficiencies, accelerate innovation, integrate disparate systems without customization, and improve customer experience. They can extend the functionality of their products while saving time and money and thus stay agile in the marketplace. Fintechs can help in digitization of supply chain, invoice-based payments, and payments at merchant-based locations. This should enable the digital banks to offer end-to-end solutions to their customers. Fifth, the digital banks would have to maintain financial strength and the capacity to absorb unanticipated shocks and stress. Human resources who are capable of solving problems rather than shuffling the papers around, as is the case with the commercial banks now, would have to be inducted and trained. A balance between tech-savvy and business-savvy professionals would have to be maintained, as a tilt towards either extreme can be deleterious to the bank. A new culture is to be nurtured by the digital banks that is markedly different from what we have today and is customer-centric. And I was very happy to hear Shahzad saying that what his pride is that he is able to transform 13 or 14,000 of his employees in a different cultural environment. Unless you do that, the digital banks, as I tell the Islamic banks, that you have taken people from the conventional banks, but their mindset is still the same, and their cultural traits are the same. So you have to make a departure from the traditional way and unlearn what you have done and learn new things. That is what is critical for yourself. Sixth, with rapid advances taking place in technology space, the banks would have to constantly strive to catch up with new innovations and practices. Partnerships with foreign technology service providers would enable continuous upgrade, enhancement, refinement of the systems and software applications to tailor-make them to keep the competitive edge and customer satisfaction. Let me conclude by a word of caution. The risks arising from adoption of technology as a delivery vehicle are in addition to the credit risk, market risk, and other bundle of risks which are associated with financial intermediation. Ensuring cybersecurity, preventing fraud, guarding against identity theft, hacking of the databases, poor customer interface up front, frequent breakdown of back office systems, congestion of traffic that keeps a customer waiting for a long period would require close vigilance and attentions by the chief executives and the managing directors of the banks. They cannot just delegate this to one of their subordinates and sleep in slumber. Thank you very much for it here.
Thank you, Dr. Ishrat. That was very thought-provoking.